In this example, we'll be doing practice exercise 15.5b that can be found in your textbook on page 695. We are going to be journalizing the adjusting entry required to value our available for sale securities at fair value. The example tells us on January 1st, 2014, our valuation allowance for available for sale investments had a zero balance. On December 31st, 2014, the cost of the available for sale securities was $24,260 and the fair value was $26,350. And we need to prepare the adjusting entry to record the unrealized gain or loss on the available for sale investments as of December 31st, 2014. So the first thing that we need to do is compare our cost to our fair value of our investments. So as of our balance sheet date, which is December 31st, 2014, they tell us that our cost for our available for sale securities was $24,260, meaning that is what we paid for all of our investments that we've classified as available for sale. As of our balance sheet date, remember your balance sheet is always a snapshot of your assets and liabilities on a particular day, is in fact $26,350. They tell us that our fair value as of our balance sheet date, December 31st, 2014, is $26,350. Remember, your balance sheet is always just a snapshot of the values of your assets and liabilities on a specific day. So, although those available for sale investments cost us $24,260, if we had sold all of those available for sale investments on December 31st, 2014, we could have sold them for a total of $26,350. So we now need to figure out our difference. We take our fair value and we subtract away our cost. And in this case, we have a positive number, which means we have an unrealized gain. It's unrealized because we didn't actually sell these investments. The fair value of these investments could change every day. So again, it's unrealized because we didn't actually sell our investments. So on December 31st, we need to do an adjusting entry using our valuation allowance account. Our valuation allowance account can either be a contra asset or an adjunct asset account. In this case, we would like it to be an adjunct asset account because we want it to add $2,090 in value to the cost of our investment to arrive at our fair value. So if we want it to be an adjunct asset account, we are going to debit the valuation allowance account for our available for sale investments for a total of $2,090. We are then going to credit an unrealized gain or loss on our available for sale investments of the same $2,090. Something to point out here that is different from our trading investments is this account. Notice it says unrealized gain or loss. We do not have a separate unrealized loss account and a separate unrealized gain account. The reason for that is our unrealized gain or loss on available for sale of investments would be on our balance sheet in our stockholder equity section. Remember, these are being classified as available for sale. This is not what we as a company do for a living, so it's not going to impact our income statement. For our balance sheet presentation, we'd have our investments in our available for sale securities. For a total of $24,260. We would add to that our valuation allowance for available for sale securities, which we know is an adjunct asset of 2,090. We would add those two together to get our investments in our available for sale securities at fair value of the $26,350. Keep in mind that the valuation allowance account did not have a beginning balance. If it had, we would have had to consider that when determining the amount of our adjusting entry. Because again, the evaluation allowance account is on our balance sheet, making it a permanent account. Therefore, the balance rolls with us from one year to the next.